Greetings, and welcome back to the podcast. This episode, we are joined by Mr. Brad Fedora, President and CEO of Trican Well Services, a TSX-listed energy company with a market cap of approximately $900 million. Mr. Fedora has been a director of Trican since June 2017 and was most recently chairman of the board until August 2020 when he became CEO. Prior to that, Mr. Fedora was president and CEO of Canyon Services Group from 2007 until 2017, when it was acquired by Trican. Prior to joining Canyon, Mr. Fedora spent 10 years at Peters & Co., a Calgary-based investment bank focused on the energy sector, where he specialized in financings and M&A transactions for the oil and gas service and supply sector. Mr. Fedora is a former director of Horizon North Logistics, Canyon Services Group, IROC Energy Services Corp, Petroleum Services Association of Canada, and Marsa Energy Inc. Mr. Fedora also holds a Bachelor of Science degree from the University of Saskatchewan and an MBA from the University of British Columbia. He is also a 2009 recipient of Canada's Top 40 Under 40. Among other things, we discuss breaking into investment banking, Trican's 43% share reduction since 2017, and opportunities in energy services going forward. Enjoy. This podcast episode is sponsored by Conate Water Solutions. Do you need cost-effective water sourcing options to supply your next drilling or completions program? Conate Water Solutions is a specialized hydrogeology company focused on water well drilling, testing, and water management services in Western Canada and Texas. Contact info@conatewater.com or check out conatewater.com for more details. This episode is brought to you by Canada Action, whose aim is to promote the importance of Canada's energy industry, which is the bedrock of our nation's economy, providing hundreds of thousands of jobs and economic opportunities across the country. Learn more at canadaaction.ca or check out Canada Action on social media. This podcast is sponsored by headracingcanada.com. In partnership with four-time Olympian Manny Osborne Parody, headracingcanada.com is now offering free shipping on European factory performance ski gear. By passing brick-and-mortar savings on to customers, headracingcanada.com offers the lowest pricing available in Canada. Check out headracingcanada.com for more info and get your new ski gear for the season. Good morning, Mr. Brad Fedora. Thank you very much for doing this. I really appreciate your time.
Thanks for having me.
For the listener, you are the CEO of Trican Well Services. But for anyone that is listening, what is Trican Well Services?
So it's an oil field services company, and as everybody knows, our customers, they pick the locations of where they're going to drill and complete these wells, but the service companies actually do the work. And we have all the people that are employed in the field that actually, are running the equipment and driving the trucks that are, working on location to actually drill and complete these wells. And so what Trican does is we're called the pressure pumping company. And so we most of our work is fracking. It's about 70% of our work. And then we also cement and have coil tubing. So, we're involved sort of at all stages of the well and lots of heavy gear running around, lots of people. It's really interesting.
To rewind the clock a little bit, how did you get into energy?
Good question. I really came to Calgary. I was in school. I was working in school in Vancouver. When I finished, I was doing an MBA out there. And when I finished, I wanted to get into investment banking, but I really didn't target energy. I wanted to live in Calgary for the fly fishing. So I targeted coming to work here. And it was funny. I was thinking about that when I was looking for a job. I used to get up at 4 and 5 in the morning and phone all the investment banks in town, because back then, outside of normal business hours, you had party lines. And so I remember I worked at Peters & Co. and after hours, every phone in the office would ring. And so luckily, I'd sort of figured the way to get through the receptionist and get through to the head of corporate finance, which at that time was a guy named Bruce Fiel, was I'd phone him at, 5 and 6 in the morning. And, he must have been wondering, like, who the hell is this kid calling me at, 6 a.m. But, he was in early for what was, or I think probably still is, a 6 a.m. morning meeting. So it's actually how I got the job was, I was crafty enough to call early before the receptionist could screen me. Worked at Peters & Co. for 10 years, give or take. it's been great. Was a fantastic place to work, and didn't get to do a whole lot of fly fishing, unfortunately. It was mostly work. But yeah, I came to Calgary for the fishing.
Do you remember your first day at Peters & Co.?
I do. I think it was Feb 2nd, 1998. You get in early, so it's always dark when you're getting there and when you leave. But it's pretty uneventful. I think you just sort of pointed me at my computer. I sat down and started banging away. I think the training program lasted about 12 minutes. And so it was sort of trial by fire. And luckily I was able to make it through. I think it was pretty touch and go there for the first 60 days. But I remember that I worked directly for a fellow by the name of Chris Potter, who is now the chairman of Peters & Co. and I think he's been in investment banking longer than anybody. I think he's got to be 28 years or something like that, which is almost unheard of in this industry, especially in Calgary. But yeah, and so, he's been a good buddy of mine ever since.
Was the idea to get into corporate finance?
It was, yeah. The thing about Western Canada, if you want to stay in Western Canada and you want to work in sort of that capital markets part of the world, as it turned out, there was a bit of sales and trading, but really most of the jobs in finance, in investment banking are typically corporate finance jobs. Most of the sales and trading is down east, right? In Toronto and New York, obviously. So, if you want to stay in this part of the country, you're better off in corporate finance. And, that's 25 years ago. But even then they were talking about automating trading and sale, the lack of the need for an actual sales and trading, a manned sales and trading desk. And it's still going. I think a lot of people, if you had asked them 15 years ago, would that part of the capital market still exist today? I bet you, a lot of people would have said no. But yeah, it's still going. I think, there's not that many trading desks around. I think it's probably just Peters & Co. that has a main sales and trading desk. And I guess Stifel would have a small one as well. But I know a lot of their operations have moved to the east. It's only Peters & Co. that has a head office here in Calgary. So they kept all the sales and trading here. But yeah, I wanted to work on deals and I wanted to learn about companies. And so that's the path I went down.
Coming from Vancouver, did you miss the warmer weather? And did you get a sense of the opportunity in Calgary? Is that the reason why you came?
Yeah, well, I grew up in Regina and it was just happened to be working or going to school in Vancouver. But yeah, you certainly miss, people complain about the rain. I didn't find the rain to be a big deal. Sitting on a patio in the middle of January at +8's not the worst thing in the world, right? You got to get bundled up. But you see the Europeans do it, but no one around here seems to. So yeah, and you can fish all winter in the rivers there. So that was a nice treat, and not having to warm up the car. And sure, but it's pretty gloomy out there, right? So you certainly appreciate, we're sitting here on the 29th floor and overlooking the mountains, and it's sunny out, and it's a fantastic place to be. But yeah, the warm weather in January is hard to beat.
But opportunity was in Calgary.
Yeah. Even back then, even as a student, when you were targeting investment banking, I didn't just come here for the fishing. At that time, I bet you the investment banking community and the number of deals that were done probably was 3-4 times the size of Vancouver. Right. And so it became pretty evident that if you wanted to work in corporate finance and actually work on live deals, you're much better off living in Calgary than in Vancouver for sure. And that back then, we had, the oil market had sort of boomed in the 90s, and First Energy had started up, and you started asking around. Everybody basically said, you want to work at Peters & Co. or First Energy because they're employee owned, local firms, and they were sort of getting the lion's share of the work. And then I think oil went to $9 shortly after I joined. Things came to a bit of a grinding halt. But yeah, you could feel it even when you were looking for jobs. You could just feel the energy of downtown Calgary versus downtown Vancouver. And, subsequently, the 10 years I spent there I was incredibly fortunate to the timing that I had, because oil had gone to $9. Remember that cover of The Economist saying that oil would be $9 forever. And then shortly thereafter, it marched its way up to 150 or something like that. So we went through this, or I was at Peters & Co. for this sort of 10-year run of live deals. I mean, man, we barely even made an outgoing phone call. We were so busy. And that's really fortunate because, of course, you don't learn anything if you're not working on live transactions. And given those incredibly long hours that you had to grind out, it's a lot more interesting when you're working on something live. And then, of course, pays better too when you're transacting. So I had a great run there. I miss the guys in that place a lot. Like I feel really fortunate to have worked there.
Sometimes 10 years at an investment bank is a long time. You were loyal. Did First Energy ever try and poach you?
No, the odd firm here and there. But, back then, everybody, I was too junior. Like if you were looking to poach anybody, you'd poach someone senior, not someone like me that was just learning the business. So no, I settled in there for sort of fairly nicely. And, I think people quickly figure out who's happy and who isn't. And so they're really, I never even really thought about leaving, other than the odd time here and there, but there was just no reason to. We had it so good.
Maybe one or two of the biggest lessons you took from Peters & Co.
Oh, there's lots of bright people out there.
Working for Mr. Mike Timms.
Yeah. And, I was really fortunate. I had Mike Timms and Ian Bruce and Bruce Fiel, like the senior, the older senior guys. So you could not have asked for a better group of people. And then, the guy that was up and coming at that time was Chris Potter, and subsequently Cam Pluis joined the firm. And, we just had this unbelievable resource of highly intelligent, hardworking people there. And, probably the lesson I took is it's really hard to beat somebody that's bright and is willing to work really hard and has integrity and a good work ethic. That's a tough combo to beat. What I really loved about my time at that firm was never at any time did I feel we weren't acting in the best interests of our client. And we kind of had this saying, like, if you wouldn't sell this product to your parents, then we shouldn't be selling it to the investors. And, there's not a lot of places that can say that, right? Like, it never, I was lucky, like everybody kind of shared my value system that I worked with there, and, the people that I mentioned. And so never were you sort of put at odds with how you wanted to do things. Everything I would say was done with like the utmost level of integrity and ethics and all of that stuff. So that was really, and still is very important to me. So that was really important to me back then. I mean, Ian Bruce used to say, you only get to sell your reputation once. You better get a good price for it. And so, I thought very much the same. And I think those people and myself still conduct ourselves like that today.
When the inevitable conflict came along, was it a quick no, or how did you deal with those situations?
It was really, I don't even know if there was a conflict. I mean, we walked away from deals all the time, like things that didn't look right, smell right. We had the odd client where, I should say I had the odd client that quickly figured out they don't share your value system or your sense of right and wrong. And, they're not clients for very long after that. So, I was fortunate. We kind of pre-screened all that stuff. And so you never really, I can only think of one instance where I was working on something where I was like, boy, this guy, sees the world differently than I do, from an integrity perspective. I won't name names, but that was really the only thing I can think of. We were fortunate, right? There was so much work going around at that time. You had to work for the work, but you could really sort of pick your lane almost, and then, like-minded people come together eventually. And so our clients were, most of our clients were just like us.
One of the products of the 90s/2000s energy investment banking market was the bought deal. Do you ever remember a time where you were a little stressed on a situation like that?
Oh, yeah. And I mean, remember that we worked at a boutique employee partner-owned firm. And so, due to regulatory requirements, when you do bought deals, the firm had to have a certain amount of capital. And I can still remember the first time because, I was a very junior partner fairly early on. And inevitably, you'd have a busy week and you'd run short of capital. So they'd walk around and go, hey, we need your check by the close of business tomorrow. And you're kind of like, really? And yep, you had to get, put your money where your mouth is, right, at a boutique. So it was, again, like that. I love that part of, the fact that we we owned it and we were risking our own money. And I mean, you learn about risk reward when it's your money on the table very, very quickly. Right. And, I was sort of, because of that, actually, I've always kind of lived below my means because you never know when you're going to need money, even though I don't work there anymore, but I still seem to think like that. But yeah, it's, you learn quick lessons at a fairly young age when you got to get your checkbook out.
So what happens when you're short? What in that scenario?
Well, there is no short, right? I mean, you have to put the money up. There's like a regulatory requirement for, X amount of capital based on the number of the value of bought deals you have out there. And then, once, I don't remember the mechanics now, but, once it's sold and closed, obviously, it frees up a bunch of capital, but there is no short, right? You've got to get your check. All the partners have got to get their money in the till and you got to get it in quick. You don't have a week to do it. You've sort of got 18 hours to do it. So you better make sure you had it available. And I remember it used to drive me crazy when you'd hear people talking about how, we never took risk. They thought it looked easy from the outside. And so we just sort of clipped a coupon when we're passing the money around. No, it wasn't the way it was at all. We thought long and hard about things before we put up bought deals for sure.
Maybe one of the differentiators of a good investment bank is it has a mentality where there is some stress on the deals.
Yeah. I mean, and they were competitive, right? I mean, I'm a long time out of that business, but they're always very competitive. And so, you were typically pricing them right to the edge or else one of your competitors would steal the business from you, right? So you're always a little unsure as to how they're going to go. You never know, you can't pre-market. It's against a lot of pre-market those, but you always had a pretty good sense of what your investor base was doing. So, I mean, it wasn't, you went into them with lots of background and lots of education, but there's always things that happen overnight. News events happen. People get in arguments. Countries can collapse the price of oil in a pretty quick period of time. And so, yeah, you're taking a risk. There's no doubt about it. If you didn't enjoy the stress, it wasn't the business to be in.
What to you makes a good investment banker? Is it slowly developing relationships with people and proving your acumen, or is it just basic care?
I mean, man, I'm probably not the best person to ask. I mean, again, it's hard work. You obviously, you got to be bright. That's table stakes, obviously, but just instincts for the market and instincts for what companies are thinking. And if you don't have those relationships, it's pretty hard to find out what your customers are thinking. And it's weird, like there's always a personal element to all of this because there's numerous, whether it's bankers or lawyers or accountants, there's always numerous service providers chasing the same clients, right? And some people click and some people don't. And first and foremost, from an investment banking side, you have to give good advice, right? And if the client trusts your advice and, you have a personal connection and you work for a high quality services firm, I mean, pieces come together and hey, you don't always win. It doesn't matter, even today at Trican, we've got lots of incredibly long-term clients, but we don't, for whatever reason, you don't always win them. You'd like to think you're going to get every piece of business that you want, but it's tough out there, right? It's competitive. It's incredibly, what's great about Calgary is this, it's not a huge industry, but it's incredibly competitive and the quality of your competitors is high. And, there's not too many slouches walking around the streets of downtown Calgary.
How did you balance the small town nature of Calgary, so to speak, with independent thinking in a leadership position?
That's the trick.
Also at Peters & Co.
Yeah, we often say, the problem with Calgary is that we're all in the same business.
Yeah.
It's a small town. You kind of know each other. Groupthink can happen for sure, right? And, you think about continuing education and, some of the up and comers here at Trican, we make sure you are not taking that class at the U of C. It's not because I don't think there's great stuff happening at the U of C is, we don't want them in class with other people in the energy industry. Go down east or go west or go sit in class with people that are in other sectors of the economy. And because there's so much there's so much to learn, obviously, from people that are in different businesses. And that's the challenge with Calgary. I mean, your neighbors are in the oil and gas business. Your friends are in the oil and gas business. Everything's oil and gas here, right? I think it's important to step outside that to, see what else is happening out there.
Well, maybe to segue to Trican, after Peters & Co. 10 years or so, you transitioned into energy services. What led to that?
Yeah, like I always wanted eventually to get on this side of the street. Banking is great, but the only thing that I didn't love about it is you were sort of in the middle of what other people were doing, and just when things were getting interesting, and a lot of times our job was done. And so, I those are dog years, right? So 10 years in investment banking feels like an entire career, but you only live once, and wanted to do a few different things. And so I had a client we had just taken public, and, their whole corporate strategy stumbled just because of what was happening in the commodity world. That's back when, I don't know if you remember, coal bed methane was all the rage in Canada. There was thousands of wells predicted every year. And then almost overnight, it just almost went to zero. And so this company called Canyon that I joined was started to do coal bed methane. And so they had to, reset strategy and sort of, reconsider what the equipment they had built. And the client that I had that was running Canyon at the time, he was like, I don't sort of feel like restarting all of this at my age. And so he convinced me to join, and it was great. I didn't know anything about fracturing, but I did. The company was struggling a little bit financially. And so, the skill set that, I had developed at Peters & Co. was actually exactly what an organization like that needed. And so we got it fixed up, and, we sort of recapitalized it, expanded, bought up a bunch of equipment, moved into the Montney, and the rest is history. And then I think I worked at Canyon also for about 10 years, and then Trican bought it in 2017. And so we had sort of grown Canyon from sort of this 20 million market cap company to over $1 billion at one time. And, we became a real competitor. And so, and we were kind of like-minded with Trican in many respects, with sort of our approach to the business and the customers. And so, there was this sort of growing need for services companies to become a lot bigger, because all of our customers were consolidating, and capital sort of deployment was totally different. Wells went from costing sort of $1 million to $8 million, and it became almost more of a manufacturing exercise in plays like the Montney. But in order to keep up with what was happening, you as a service company had to get bigger and more sophisticated, and you had to have a more robust technical team and have the capital to keep up with the equipment evolution that was going on, because there's always changes in equipment, and they're incredibly expensive. Your average frac spread is $50 million, give or take, to buy. And so, little small cap companies, it's a tough space to play in, right? I mean, even we're just below $1 billion. I mean, I feel like we're way too small even at this size. And so we ended up discussing, the fellow that was running Trican at the time, he and I ended up discussing the merger of Trican and Canyon, and sort of took about a year, and eventually their stock popped up. So he was able to offer us a premium, and they acquired us. And then I sat on the board for a couple of years and sat on the couch a bit, and then I came back to work.
If I'm correct, you're the top inside owner of Trican nowadays, but have you always felt it was important to eat your own cooking?
Absolutely. I mean, again, it's one of the lessons learned at a place like Peters & Co. or, some of these other boutiques like First Energy and even Cormark and places like that, where the principals have their own money, and, why would you not want to be working for yourself? And if you're not confident enough to invest in your own venture, then you probably should be doing something else. Like many people, probably made more money investing in myself than I have others, with the exceptions of Mike Rose's of the world. He's done incredibly well for everybody that's invested there. But for the most part, try to invest in things I can control.
Easier to get out of bed in the morning.
Absolutely. Yeah. Like never do I wake up, go, man, I don't feel like going to work today. Like, that's never happened. Right. I love the responsibility of the organization. And as a result, I'm hardly the first person into the office, but you're always thinking about it. That's for sure.
Well, getting to Trican a little bit, maybe the energy services side in general, what to you makes a good energy services business?
Yeah, I mean, it's like any business. You have to have good people. You have to have good value add service offering. In our space, you have to have good equipment, and making sure that you're sort of on the forefront of sort of technical evolution and bringing it all together to provide a service that your customers value and they're better off for it. I mean, it's a very competitive space and there's lots of people trying to do what we're doing. Lots of frac companies have come and gone. Financially, it's like I said, it's lots of money and lots of people going around every day. And so it's a tough business to compete in because you got to get all things right. And so I think what we do really well is we have the best equipment. We've got the best technical team. We've got like what we feel is the best logistics in the right places. And so all of that mixes together to benefit our customers more than they can get from one of our competitors.
When you take the reins of a company, sometimes the momentum's in your favor and it's easy to keep that up. But how do you keep it up after a few years? Is it because your own money is involved or how do you keep it up? That's a good question. And it's something people like me, I think, ask themselves every day is, making sure you don't overstay your welcome. And like you said, you're not just coasting along because, as you know, the months and years can go by quickly. I think there's a sort of an expiry date. At one point, it's like, okay, I think it's somewhere between 7 to 10 years where it's probably time for people like me to step aside and get in some different energy and different ideas. And a lot of the value that I would bring, once that's been implemented, it's time for fresh ideas that I'm probably not capable of at a certain stage, right? So I think it's important to know that you shouldn't stay in this role too long, right? And you better be thinking about, almost as soon as you get here, you better be thinking about who else is going to take over, who you're going to hand the keys to, and what will 5 years goes by quickly, as we all know. So you better start developing those people or thinking about who else out there could you hand the reins over. On the other hand, there are some leaders in town or in business in general that take the lead for quite some time. And it's almost like they get better through the years. Do you ever think about it that way?
Yeah. I mean, you certainly get more efficient, and the more experiences you have, the easier it is to solve problems because it's, hey, been here, seen this, done that before. Right. And so we used to sort of toil over the downturns, and now what do we do? And boy, what is this going to look like coming out the other side? And well, I've been through enough of those already. Unfortunately, I have a pretty good idea what to do, because I've had to do it. And it's funny, like the downturns can often be easier to manage than the upturns. When times are good, I'm always wondering, am I growing fast enough? Should we be more aggressive? Should we be hiring more people on spec and hope that everything works out? And, in an industry like this, where whether you're building equipment or hiring people, you need about a year lead time for all of this to come together. We just upgraded a bunch of equipment here to this new natural gas technology. It burns natural gas instead of diesel. And man, I think we had about a 14-month lead time to get that equipment out of CAT, right? And so you're always trying to make decisions based on what you think is going to happen. But you have to look sort of 2-3 years down the road in an industry where it could all be totally different within 2 or 3 months, right? And that gets back to, sort of that prudent financial management and making sure that, you're never going to put yourself in a position where you become vulnerable or overly vulnerable to swings in the market. And so it feels like you play a little bit of defense all the time, which, gets a little old, but it's critical. It's critical to do it in an industry where things change so quickly and so drastically. I think now it feels a little less volatile than it used to, or maybe the swings aren't not quite as wild. But yeah, like, I have a certain skill set that sort of it was built in this industry over the last 20 years or 25 years. And, but maybe for Trican to go forward another 20 years, maybe it needs a different sort of skill set, right? Maybe you need someone that's more technology based or, is going to think of new ways to motivate these young people, or, there's all sorts of things that are constantly changing, and you got to make sure you step out of the way and let people that can do it better than you, do their thing.
Speaking of volatility, the Trican shares, 2006 around $30, by March 2009 $6, by 2011 back up to 26, during COVID around $1, and now it's around $5. So I guess the question is, why so volatile from your perspective?
Yeah, I mean, I just joined Trican in 2020, so I'm probably not too much help on the period before that. But I mean, it's an industry, because the oil and gas industry and the commodity prices are so volatile. Capital budgets grow quickly overnight. They get cut quickly. We go from being sort of understaffed to grossly overstaffed, and we have one day you can't build equipment fast enough, and then 6 months later you can't park it fast enough, and so we're at the tip of the tail that the dog is wagging. So it just makes for a very volatile sector in what we call pressure pumping, and that's why we're so fiscally conservative, right? Which is so much of our success or failure we have very little control over. From we can't control how many wells get drilled in the industry. So you got to make sure that you can sort of fight your way through that volatility. It does feel like the industry is less volatile than it was. And Trican had gone through a history of international expansion, and Canada had gone through this incredible sort of growth period in from sort of 2000 to 2008. So there's all sorts of volatility in the share price back then that had lots to do with what was happening internationally. And I don't think it was terribly profitable. And so obviously all of that had to get unwound, and debt had to get paid back, things like that. But feels like the industry is probably going to be a little less volatile going forward. And, and how do you the best way to hedge that volatility is with a clean balance sheet. And that's, I think, what the investors that invest in Trican is one of the things that they love about us, is that we're known to, very prudent financial management and making sure we never expose this company to sort of unnecessary risks or risks that we can control.
On the one hand, the best tool against volatility is the balance sheet and low debt. But on the other hand, when things are going well, it's tempting to take on debt to compete with your peers. Is there a tension there that maybe when things are going
I mean,
really
I think there's, I don't know if it's maybe taking on debt, but I mean, and I think the investors and even the employees and the board, there's definitely are we growing fast enough? There's always that, there's always that issue of, you're a public company, you need to sort of grow or die. And I don't necessarily share those views, or there's other ways to show per share growth, like, buying our own shares back instead of other companies, things like that. So, but it gets back to what you were saying, like how do you know you're in the chair too long? And maybe if we went through this incredible growth decade or something like that, you'd probably hand the keys over to someone else that, hey, you stay up all night and worry about this. I'm going to go do some less stressful things. Right. But yeah, there's always that tension of, are we growing fast enough, or are our peers doing something that we're not doing, or, our competitors. But again, in this business, I mean, you're always kind of thinking 2 to 3 years down the road. And, I think the way we sort of manage that is be ready for growth if it comes, be ready to deploy equipment and people. And you probably need to build it in advance of that, because often what happens is, things get busy. Everybody runs out and builds a bunch of equipment. And by the time the equipment's ready, things have calmed down again. And now you've got too much equipment at your company and in the industry as a whole. And so we've taken the approach that, no, we're going to be sort of ready for growth when it happens, but we're not going to get overextended or get too reactionary to it. Like today we're only operating 7 of sort of 11, 12 frac crews. So, we can almost double our crew count, in a very short period of time. It's just a matter of getting the people.
Some of your competitors, their business strategy is to buy assets 30 cents on the dollar, and that's the point. Do you think of it that way too?
Yeah, no, it's nothing wrong with that strategy, right? Lots of companies have been built. I think it's, for the most part, if done right, and you can't just buy everything because it's cheap, but in a very capital intensive business, often how much you pay for it is what is going to dictate your returns, right? And we're a business. And so my main sort of KPI is, what's our after-tax return on invested capital? And, if one of our competitors is buying all the same gear for 50 cents on the dollar, I mean, it makes for good returns. Obviously, if the money you have in is in half. Probably what's plagued this industry in the past is that undisciplined growth where everybody builds too much, hires too many people. And then when things, slow down a bit, mass layoffs and you have to park equipment and equipment becomes old and stale. And, I think, thankfully, our space now is a lot more disciplined than it probably was even 10 years ago.
One of the tools to make a good company is reduce debt, but the other one is share buybacks. Trican's been buying a lot of shares back lately. You view that as a prudent use of capital?
Yeah, and it's funny, we're sort of fortunate because everybody calls it a return of capital to shareholder strategy, and actually, it's not. We pay a dividend, which is our return of capital strategy, and we actually view the buyback as like our M&A strategy. We sit there and go, we can buy this fantastic company called Trican at these really low multiples with no deal risk or no integration risk. Why would I buy another business when I can just buy myself? So we've been spending sort of 50 to 100 million bucks a year going back before my time as well. We've bought, I think, 43% of our shares back since 2017. And so I look at it as this great M&A strategy. And, when we can buy good quality businesses for lower multiples, we'll stop buying our own shares and we'll buy somebody else's. But I think the nice thing about buying back stock is it's permanent. Once those shares have been canceled, they're canceled forever. So yeah, I think it is a prudent use of capital, especially at these trading multiples.
A few questions from Twitter, if that's okay.
Sure.
The frac business in Canada has a lot of competition.
Mm-hmm.
Thoughts on this and how it can be remedied? Is it survival of the fittest?
Yeah, it's survival. It's never going to be remedied. There's always going to be lots of competition and good quality competition, unfortunately. And it is competitive, but I don't think overly so. When you think about all the big frac basins in the world, the US is the biggest, Canada's arguably maybe the second biggest, and then there's Russia and China are also big frac basins, and for all the obvious reasons, those two markets are basically off the table. And so when we think about the fracturing space, it's really Canada or the US. And from a competitive dynamics perspective, I'd say Canada's in a much better space. Is a much better space to compete in than the US is, right? There's only really 7 pressure pumping companies in Canada. You go south of the border and there's 50. Right. And the money flows quicker in the US than it does here. And so, you can have upstarts that become as big as Trican in a matter of 2 years. Right. And lots of bankruptcies are associated with that kind of growth as well. But I would say Canada is actually reasonably stable. We've had sort of the same companies competing up here. Man, it seems like for the last 25 years. I mean, obviously we've had companies come and go, but, not a ton. And, they've typically failed during the downturns just because of their financial situation. But Halliburton's been up here forever. Liberty bought, Schlumberger's assets, BJ or Baker Hughes, they tend to come and go. But then there's Trican, Calfrac. There's now Steps about 10 years old. And then there's a couple of private companies called Element and Iron Horse. But other than that, that's about it. And, we're not even anticipating any real new competition in the next few years. And the great thing about our space is that it is so capital intensive. It's a hard business to start from scratch, because when you've got 50 million in assets and 75 people on location, just on one well, you have to have a fairly robust organization before you can even ask your customers for a job. So I actually think about the supply and demand dynamics of the equipment in Canada. I think Canada is a great place to be. And that's one of the reasons why when we get asked by investors, would you ever look outside of Canada? The answer is, well, kind of like, why? I think what we have here with the Montney and LNG, LNG exports, I think this is going to be a great space, a great place to conduct business in the next, probably for the rest of my career. I'm 53. So if I make it to 60 in this job, I'll be lucky. But I look south of the border and go, this just looks so much better than it does in the US.
What's the main difference? That just competition down there?
Yeah, I think it's because it is a small industry. There's a whole bunch of reasons. You know, the U.S., the basins are much more compartmentalized. You can start up to be just a Marcellus player or, you know, just a Permian player. Whereas in Canada, you have to sort of service the whole basin at once to a large, I mean, it's less so now just because the Montney is so active. But certainly sort of 10, 15 years ago, you sort of had to be everything to everybody in this basin all at once. And, you know, the distance between Grand Prairie and Estevan, I don't know what that would be, you know, in a truck, be 25-hour drive, right? And so in the US, you can be much more local. You've got a lot more management teams coming out of those big companies like Halliburton and Schlumberger. And then of course the capital is a lot more available, and the private equity capital is, you know, I don't know what the multiple would be, but it would probably 50 times more capital available south of the border than there is up here. And so combine people and opportunity and capital, and, you know, you will get new companies starting up. And in Canada, I think it's sort of, there's not a ton of management teams that are trying to do what we're doing. And even if they are, you know, the capital's tight, right? It's tough to get investment into this space. So typically during sort of stable or bull markets, Canada's typically a better place to do business.
One of the ways the production side to grow is through M&A. I know you can't talk about it much, but do you see that coming into the services side, or do you think about that at all?
Yeah, no, we think about it sort of every day. The challenge, I would say, on M&A, you get asked a lot about competition, bureau approval. I don't really think that's maybe as big an issue as we used to think it was, but it's really an issue of these kind of trading multiples. Everybody wants to be the buyer. No one wants to be the seller. And so we have this odd dynamic going where life's good in this industry, but yet the multiples have never been lower. And, you know, sort of the predictability of this industry, I would say, is better now than it's ever been. And again, like I said, you know, yet the trading multiples have never been lower. And so I think sort of everybody's sort of hanging around waiting for things to change. And they, you know, I'm not the person to ask if they're going to change, but so there's always that tension of, you know, who's willing to sell at times like this. And I know some of our competitors, they're young guys. They have the same ambitions I do. You know, I think they want to play this out. So I actually don't foresee a lot of competition in our space anytime soon.
There's some big fish down south too. Do you worry about the bigger fish, so to speak, coming up north?
Yeah, that's always an issue. And like I said, I don't know what, we've got 6 or 7 companies in the pressure pumping space. You kind of want to keep it like that, because if it gets too consolidated, you'll have U.S. players looking north, especially with what's happening with the Montney and LNG. And they'll say, man, I think we got an opportunity to sort of elbow our way into this. Because if you've got, you know, one player's got 40% of the market or something like that, which we would have if we were to buy one of our competitors, I think you're inviting competition at that stage. And that's, it's not something I like to talk too much about, but that's something that we factor into our M&A thoughts. You know, it's not just the merits of the particular deal, but it's what's going to happen that you sort of can't calculate. And, you know, a lot of that is how are your competitors going to react to your increased market share? And it's never 1 + 1 = 2 with market share. It's sort of 1 + 1 = 1.5 if you're lucky, post closing of the deal. And so you don't want to sort of leave the door open for, to your point, big, well-capitalized U.S. player to say, okay, now's our chance. We better get up there, get in front of all of these LNG facilities that are going to come on stream. And, you know, the Montney is obviously a world-class resource that has, man, if you talk to the Montney players, they would know way better than I would, but, you know, they would say, hey, we're in the first or second inning of this play. And so you got to make sure you don't make it too easy for some of your U.S. competitors. Now, there's so many differences between the two basins, like between Canada and the U.S., that it's always been a threat. It's always going to be a threat, but it's not an overwhelming threat because, you know, just like we don't expand into the U.S. quickly or easily, the same works the other way as well, right? It's a different place to do business. A lot of the Americans don't like the fact that we have breakup and we have so much government regulations and all of those issues. So obviously lots of adverse weather and remote operations. It's, in a lot of ways, it's not sort of in sync with what they're doing down there. They're trying to develop electric equipment that'll run off the grid. Well, there is no grid here where we frack wells. So it'd be nice to run an extension cord to the edge of the lease, but unfortunately it doesn't work like that. And so it's a different place to do business for sure.
Out of my own curiosity, how do you fend off a hostile? Curious, is it like, what do you do?
Not a whole lot you can do about it, to be frank.
Yeah.
If they're willing to pay a good premium, it's probably can't be defended. Companies owned by the shareholders. And if you offer them enough money, they'll take it. We all own stock in the company, but not enough that we could block anything. We don't have a big 30% shareholder or something like that could block anybody's takeover attempts. And so the only thing you do is you run a really good company, try to attract premium trading multiples so that if somebody decides they have to own this thing, they're going to pay up for it, and all your shareholders will have done well. That's probably the only thing you can really do. That's sort of our strategy, is just run a good company, and the rest will take care of itself.
January 23rd, 2024. How many frac spreads are currently on the fence that, even with labor, are not going to make it back into the field, given the lack of investment in the sector?
Yeah, like in the space as a whole, there's about 32 frac spreads running today, and we think there's somewhere between 8 and 10 spreads that are parked in the industry. We have 5 of them. We're not sure about our competitors. I know all of our equipment is fairly up to date and it's ready to go, because as we were refurbishing our frac gear with the new dynamic gas blending engines, we were actually refurbishing equipment that was parked. And then when our tier 4 spreads became field ready, we actually removed a perfectly well-functioning diesel spread and parked it. We've been fortunate enough that we're ready for growth, and we've put the money in, obviously not inexpensive. With respect to our competitors, yeah, I mean, if we have 5 of the 8 or 10 idle frac fleets in Canada, I would suspect there's only maybe a couple that are ever going to see the light of day again. One of the thing about, in Canada is, you can park the equipment, but you sort of never declare it obsolete. There's no sort of reason to. If it's already been written down on your balance sheet because of its age, there's no need to sort of make a declaration that, hey, that fleet is going to scrap. Previous management team at Trican had done a really good job at cleaning up its old equipment and saying, hey, that's never probably going back to work in Canada. We better sell this down into lower pressure parts of the US or even overseas. And so we're fortunate that we have a very robust field ready set of equipment. But yeah, you're right. When you think about how little money's been spent in this industry, I think a lot of people don't appreciate just how old the equipment is in Canada, right? And when you put it to work in plays like the Duvernay and the Montney, we're now pumping 24 hours a day for days on end. It was only 10 years ago when you were pumping 12 or 14 hours a day. And a lot of the equipment in Canada was never built for this type of operation. And so it's one of the reasons why I'm so bullish on doing business in Canada, is because the 32 fleets that are out working today, even those fleets need a lot of money to be updated to a standard that our customers have come to expect. And so I'm not too worried about a bunch of new equipment being built, because I think us and everybody else just needs to update what's already there. And that takes a lot of time and a lot of money. So that'll keep the space pretty busy for the next few years, I think. So I don't actually think the number of available working frac fleets is going to grow significantly, just because it can't. We obviously could put a few fleets into the field, but they wouldn't have the new natural gas engine technology, and now we've spent the last year sort of building electric equipment that goes along with our natural gas pumps, because, we want to become 100% natural gas driven on location, and it's cleaner burning fuel. It's local. Customers are producing gas. And so I think it's not just good for the environment, but it's good for the economy as a whole, and, a lot less trucks driving around and that kind of thing. So, yeah, we're all sort of busy updating and sort of staying on the front edge of the equipment evolution.
Sometimes there's a conflict between being on the bleeding edge and the leading edge. Is there, how do you manage that?
Yeah, no. I mean, you're right. I mean, and that's, I think, maybe why we don't grow as fast as we could, because, one thing about equipment technology is just like with vehicles or any other computers, et cetera, TVs even, there's always a newer, better model coming next year. And so you don't want to overcapitalize and be in a position where you can't continue to evolve as the technology evolves. So, we take what I would say is fairly measured approach to want to be on that leading edge, but at the same time, you don't sort of want to blow your whole wad on one generation of equipment, because as soon as you build it, something better is coming along. And it's like, well, like I was maybe just saying, we spent all this money changing our frac pumps to run on natural gas and, upgrading everything so it would run 24 hours a day at high pressures. And, meanwhile, there's lots of companies that are skipping over that and going right to electric, and which is, tougher to do in Canada just because, we don't have a grid. It's very remote. There's more and more demand for smaller locations, not bigger locations. But at the same time, and our answer to that is, we'll do the natural gas technology for the pumps, but we're electrifying all of the other equipment on location. That would be sort of our prudent approach to getting used to running electric gear, is take a few small steps before we commit to making the whole frac fleet and turning all the frac pumps, which is the bulk of a frac fleet, turning that electric, which is probably where this ends up in a few short years, right? So, we are learning, what's it like to run this gear? How reliable is it? The great thing about a lot of this electric equipment, it performs really well in the cold. The people like it. The customers love it, but it's incredibly expensive. And I wouldn't say, the economics could justify a full conversion to electric gear at this stage. And so we want to dip our toe in the water a little bit, learn what it's like to operate that equipment. And then when the economics make sense, then we'll probably convert the whole frac spread to electric gear.
It's kind of in vogue nowadays and cliche, but AI, is it coming to the energy services?
Yeah, for sure it is, and something that we're trying to get a handle on is, we would spend an incredible amount of money just on maintenance every year, like well over $100 million just on maintenance. And so if we can use AI to, reduce that spend, or, better pick our spots as to how and when the equipment gets maintained, or even from an operating perspective, now the old days, you used to have a person out on location and they'd be running the individual frac pump. And then we slowly sort of evolved to controlling all of the frac pumps from inside the data van. And now you go into our data van and there's, 6 or 8 big, large screen TVs where they're measuring everything and they're actually controlling everything electronically. And so the nice thing about AI is you probably can get things like, the optimum RPMs for fuel consumption and wear and tear on the equipment. And if that equipment's not running, the computer will shut it off, because, idling equipment's really hard on fuel and hard on the equipment itself. So we expect we are going to use AI probably first in the maintenance side of our business. And luckily, when you're spending 120 or 130 million a year on maintenance, there's a big prize there if you can figure out how to cut that down significantly. Because as you can imagine, implementing AI, when you've got 500-600 pieces of equipment is not going to be cheap. So, and you've seen little parts of it already, right? Where the computer is running this and picking, optimum speeds and things like that. But I think you're going to see a lot more of that.
It's pretty obvious the changes is on the horizon, but on the flip side, sometimes it's helpful to look at what isn't going to change in the business. And what do you see as something that isn't changing in energy services and that you need to focus on to
keep the people, for sure. The people, I think we'll end up with less and less people, but the equipment still has to get from A to B. And, that takes a driver and an operator. It still has to be set up and deconstructed and moved to the next location. So the people side of this business is never going to change. And something that we focus a lot on, because what we're seeing now is less of a draw to these field jobs and the kind of lifestyle that goes along with it. We're fortunate. We have pretty low turnover, but the turnover that we do get is the, people going back to the city or back to town where, they're home every night. They can go to their kids' events, things like that. So we're always trying to figure out how are we going to continue to grow and develop our staff when the competition is getting tougher and tougher every year. And, luckily, we pay well, I think, which draws a lot of people to our industry, but so do a lot of other industries, and it seems like there's less and less farm kids every year that are leaving the farm and want to come work for companies like us. And so the training programs we have now are really designed for people that have essentially no experience or no field or mechanical experience at all. And maybe that's a thing of the past with, the way computers and AI and just the electric equipment is going. Maybe we'll need a different set of people 5 years from now than we have today. But yeah, the people is the one permanent element of this industry. And it's one of those things, probably our biggest cost from an expense perspective. So you better figure out how to do it right.
Not to give away your secrets, but what's the biggest opportunity for Trican going forward? Where do you see the most fruit?
I think it's back to the Montney and maybe now the Duvernay, and just the fact that finally in this country we have figured out how to get natural gas offshore and into the global market. The North American gas market trades at a fraction to the rest of the world from a price perspective. And, as much as the government tried to stop us, we finally got pipelines, the oil pipeline and the Coastal GasLink into the LNG Canada facility, and that there's more LNG facilities to come. So that's pretty exciting, right? We've been talking about LNG and exporting more natural gas, like as far back as I can think that I've been in the industry, right? And I've flown over the facility in Kitimat, and I mean, it's a massive industrial, probably one of the biggest industrial developments in this country's history, right? And it doesn't get enough credit. I mean, it's funny, you still have the odd investor, particularly in the East, that is wondering if LNG is even real. We've got a prime minister saying, there's no business case for it off the East Coast and all sorts of ridiculous things like that. But I think the opportunity is finally Canada's on the map, right? From a global commodity perspective for both oil and natural gas. And I don't know about you, but I'm a big believer that natural gas is sort of the fuel of the future. And when you think about sort of transitioning to a lower carbon environment, whatever that means, natural gas is the way to do it. And, even if the world wants to continue to drive electric cars, or that electricity obviously has to get generated somewhere. So why not use Canadian natural gas to do it?
Well, maybe to end on a light note, up to this point, favorite time in your career?
I would say probably I had joined Canyon. We had spent a few years fixing it up, and we had recapitalized it, and we'd built a bunch of equipment. And then it really clicked. We went from the sort of small, unheard of company that everybody thought was going to fail to a real contender in the marketplace, right? And it's nice being the underdog because you can get a lot done without anybody noticing it. And we did that. So we had this sort of euphoric run from 2010 to 2014 where it seems like everything we did just came together all at once. And, we were the most profitable pressure pumping company in the industry, like by a mile. People were happy. The company was making good money. The shareholders were happy. The employees were happy. The customers, loved the work we were doing. Like it was, you knew those times weren't going to last, but they were sure fun. They were sure fun while they lasted for those 4 years.
A lot of people look to you nowadays at Trican for advice, or maybe in the industry in general, but is there anyone that you look towards for advice?
Man. Yeah. I mean, I've been fortunate. Like I said, I talked about the people that, the senior people at Peters & Co. But, I also had lots of great board members and a lot of the people that I looked to for advice ended up being some of my clients that, I had because I concentrated in this oil field services space. And so a lot of my clients to this day, I mean, one of them is my chairman and the others are good friends of mine. So I've been incredibly sort of fortunate. It's the great thing about this industry in this city is there's so many great people that have done, big things that they're all genuinely incredibly humble and willing to share sort of the lessons they've learned. Right. So I've been really fortunate. I've had, and still to this day, I mean, there's so many people that I can pick up the phone and call to say, hey, what would you do? And, you get an answer, you get a really good answer pretty quickly.
Maybe to wrap up, advice to a younger person entering the energy industry or business in general, what would you tell them?
Well, I think just stick to the basics. It's, if you're bright and hardworking and you're tenacious and committed to what you're doing, that's a pretty good way to start. And don't expect too much too quickly because it's going to take time and lots of hard work.
Well, that's it. Thank you very much. We can end a formal conversation there.
Thanks for having me.
Hello, listeners out there. Thanks for checking out the podcast. Hopefully the episode provided some insights. If you enjoyed the show, check out trose.ca where more episodes are yet to come. You can also subscribe to the podcast where your token of support is much appreciated. Until next time, happy coffee drinking.